Welcome to STRAT this week. Will Woodall, Mike Rarey. Mike, I'm freshly back from Arizona where my son graduated from college last week. So glad to be back. Congratulations to Ethan. Looking forward to seeing him take on the next chapter of his life. I'm sure you are as well. So, and today we're going to take a look at last week's performance and give some updates on sort of the changing market dynamics we're seeing in performance and in sort of the inflation in our framework outlook. So let's first start with the equity returns from last week and comment on year to date, please.
Yeah, for sure. Yeah, last week, not a whole lot going on. But if you look at the returns year to date, you can definitely see how the market environment, how the equity leadership has changed throughout the year. So year to date returns, large cap S&P 500 up over 8% on a total return basis. And you look at where that 8% is coming from, it's predominantly large growth stocks. And increasingly, it's becoming fewer and fewer large growth stocks, really only the largest few stocks in the index doing all the heavy lifting.
Yeah, interesting stat I saw this morning that Apple now has a market cap bigger than all 2,000 of the Russell small cap stocks, which
That's right.
is just trying to put your head around that is insane. So
Yeah. Yeah.
let's take a look in more detail at to what you mentioned there in terms of large cap returns and what's driving the market.
So some of you all may recall, if going back to January, the bear market rally at the beginning of the year, it was primarily smaller cap stocks that were, the big market leaders. And sort of as the year has transpired, small cap stocks, one way, shape, or form, have fallen by the wayside. And now it's really just 8 stocks that are representing all of the year-to-date returns for the S&P 500. I mean, this chart shows the 10 largest by market cap in orange versus the other 490 in green. Really, though, you only need the 8. And we have them listed there: Apple, Microsoft, Amazon, Alphabet, Nvidia, Berkshire Hathaway, Tesla, and Meta. And combined now, those 8 stocks represent about 25% of the index and are up, roughly 35% in terms of returns. So you do the math, and there you go. Those are your returns for the year. You take those stocks away, and markets have done nothing year to date.
And so for the viewers, Mike, just comment on what this imbalance sort of means, what it signals, to the market or to the economic landscape.
Yeah, it's, if you were to paint a picture of the healthiest market environment you can think of, that would happen during a very healthy, within a healthy economy and a healthy earnings sort of trajectory, it would be sort of the opposite of this. The largest stocks would be up probably less than the market. They'd still be contributing a lot because they're large, but you'd see mid and small cap stocks that are more economically sensitive getting rewarded and having the gains be sort of robust and broad based. You'd have very diversified leadership throughout the market. And yeah, this is the exact opposite of that. I mean, it's very top heavy. Generally, this type of leadership is very unsustainable. And it's not uncommon to see this type of narrow market leadership, towards the very end of market cycles.
Mm-hmm. I mean, you could say some of these companies on this list have pristine, awesome balance sheets that you would want to own the stock, but some of the others, no way. So it's not just about quality,
Right.
which is important. So let's move on to fixed income. Pull that chart up for the week.
Yeah. And fixed income returns, the Treasury yield curve, I mean, relatively speaking, it's been stable compared to earlier than year and compared to in March in particular. Bond spreads have been somewhat stable here the last, thus far in May. But year to date, green across the board, positive returns across pretty much every fixed income sector within the market.
Yeah, just a little update on some Fed speak. I think there's been a couple comments about raising interest rates. I think the market's still hoping that the back half of the year we're going to see cuts. And I think there's been a lot of rhetoric coming from the Fed that they're not even thinking about cutting. And it was evidenced this morning in a comment. But they really feel like end of 24 might be the first time they're looking at potentially cutting rates. So
Mhm.
the market and the Fed are sort of on opposite ends of this, and we'll see who wins, I guess, in the end. But right now, it doesn't look like there's any appetite for rate cuts this year.
And when we look at the alternatives chart, we really want to focus on the 1-year time period because we're now approaching sort of peak base effects within the commodities complex, particularly energy. You look at energy over the 1-year period, down 40%. The Bloomberg Energy Index, which consists of things like WTI crude oil, Brent, natural gas, etc., it peaked last year in early June and is now down significantly from there. And so, what does that mean? Why does that matter? Well, what you're going to see is probably only another month or two of significant negative base effects on headline CPI because of this. Food and energy have come down real sharply. But once we get into the summertime, the declines in headline CPI are going to be much harder to come by. It's going to be more sort of drifting sideways. So that's key. It's a bit of a regime shift. Whenever you're looking at inflation and you're looking at commodities, you always got to think about what was going on 1 year ago. And obviously, if you think last May, June, commodity prices were very, very, very high. So
Yeah, absolutely. And if you, as you, it's funny because anecdotally, I went to fill my car up with gas yesterday, and it was over $5 a gallon again. And it just seems there's such a lag there, and the inflation still is taking a bite out of people's wallet.
Mhm.
All right, let's move on to framework talk.
One thing to notice, since we're talking about base effects, is money supply M2 peaked in 2022 at about $22 trillion. And now it's sitting well under $21 trillion. So that's where you see the big slowdown in the solid blue line. And we make that point because once again, on a rate of change basis, the April money supply numbers should mark the end of the slowdown. Basically, that should be the worst this line gets. From there, you see our forecast. It sort of goes sideways for a few months, so still declining on a year-over-year basis, but on a month-over-month basis, basically moving sideways. And then it looks, oh, look at this sharp recovery in liquidity we have starting around August, July time period. And it's really not a recovery in liquidity. In terms of actual dollars in the economy, basically we're moving sideways through the entire forecast horizon. It's just on a year-over-year basis. It looks like the numbers would be going up to something like 0% money supply growth.
Mhm.
So typically rising liquidity is a good thing within our framework. But in this instance, we're barely even rising back up to a positive year-over-year number. So it's just going to be a really difficult liquidity environment. And every single day, now that the market is expecting rate cuts in the back half of the year, every single day the Fed does not cut is tighter monetary conditions than the market expects. That's a very difficult situation. Where now basically if the Fed does nothing, they're tightening, right? Quite different from last year. I think it's something that the market still hasn't fully rationalized.
Yeah, I mean, just sort of to the saying, it happens slowly and then all at once. Once the market does realize it, it's going to react quickly, most likely. Before we move on to inflation, talk about the impact we're starting to see in the credit availability banks are making available, and how that potentially is starting to impact consumer spending and the mortgage or the home market, et cetera.
Yeah. Last week, the Fed released their senior loan officer opinion survey, and they only released that quarterly. So everybody was sort of fearing the worst, and it was almost that bad. So pretty much across the board, banks tightening lending standards, showing decreased demand for new loans, and then also much lower loan availability, so ability to generate new loans. And you saw it for pretty much every single type of loan. I mean, consumer loans, C&I loans, commercial real estate loans in particular. And so this is definitely where liquidity is now biting. The inverted yield curve is now biting and starting to create some knock-on effects for real economic growth, which should definitely be slowing.
Yeah, you need credit to grow the economy.
Mhm.
All right, let's move on to inflation, because that's a big area of focus by the Fed in particular.
Mhm.
And look at our forecast.
Yeah, and we received the April CPI data last week, and that was pretty much right in line with expectations in terms of a month over month and a year over year. So no huge surprises there. And if you start to look into our forecast horizon and you focus on headline CPI first, you'll see we expect a pretty big decline next month. So when we get the May numbers, and that's once again because what we were talking about with year over year and base effects on things like food and energy prices, but then sort of moving sideways throughout most of the summer, struggling to get down to around 3% 12 months out from now. So our forecast goes through April of 2024. And if you look at core CPI, just not making enough progress, just not coming down fast enough. 12 months out, so we're almost talking mid 2024, you're still seeing core CPI running at 4%, more than twice the Fed's stated goal. So that's going to be very frustrating. And then if you look at what the Fed is really narrowly focused on now, which is super core inflation, so that's within the core bucket, isolate the services, strip out housing. That's still over the last 3 months, if you annualize it, it's running around 5. So, just reinforcing everything we've been saying for quite some time now. The Fed is making progress, but they have way more work to do. Arguably, the easy part is over. This will be the tough part, getting inflation down to their 2% target from here.
Yeah. And with the big disconnect in the market, expecting rate cuts in the back half of the year to what our forecast and what the supercore numbers look like, sort of handicap the break here. Like what's going to break first, and how will the Fed sort of respond to things continuing to break throughout the rest of the year?
Yeah. It's going to be really, really tough. We're seeing typically how it'll work is monetary conditions, so things like money supply, that cycle busts, right? And then you see ramifications for the economy and financial markets. We've already seen financial markets, and now we're starting to see the real economy. And then inflation will start to turn over. So inflation's the last part, sort of in the cycle. And so, what breaks from here? If you look at things like senior loan officer opinion survey, if you look at what's been going on in the banking system, clearly the financial system is starting to have issues. The banking system, credit availability. The yield curve didn't matter for a long time. Now the yield curve being inverted matters a lot. So, they've already shown that they're willing to tolerate financial problems, right? The Fed has tools to solve a banking crisis. Clearly, they're very good at it. They're experienced with that, and that has not stopped hiking. What's next? What would be really difficult is if unemployment starts to increase, and now the Fed is standing up there, and you see, say for example, hypothetically, 100,000, 200,000 jobs are lost in a month. And now Jerome Powell is at a press conference saying how they held the Fed funds rate steady at 5 to 5.25. That would be sort of the what moment. That would be really difficult. But that's potentially what we're setting up for, is something like that, unless these inflation numbers come down way faster.
Yeah, and that is not our base case. So let's move on to economic growth, because we do have some updates here.
And so the actual Q1 number, the BEA's first advanced estimate of the Q1 number is in here. So this is 4 quarters out. So this goes into Q1 2024, and expect basically no growth, real growth on a year-over-year basis. And if you were to just look at calendar 2023, it's looking like Q1 was all the growth for the year. That's basically it. Expect quarter-over-quarter numbers from here on out to be, just barely positive or just barely negative, but in aggregate, virtually no growth from
here. And that's sort of manageable from the Fed's perspective, the no growth to fight inflation. What's the probability of negative growth versus the probability of positive growth? I mean, you sort of
Yeah.
handicap both ends of this.
It's a very, very narrow path. It's sort of a narrow path, but the upside risks are bad and the downside risks are bad. So the problem the Fed has is they want to see exactly if they want to see this exact forecast happen. They want growth to be very slow, enough to bring down inflation, but not so low that they start dealing with unemployment problems, right?
Mm-hmm.
And if economic growth is worse than that, which towards the end of the cycle with everything we're seeing in the banking system, it could definitely be worse than that. That's a problem. Fed doesn't want to see that. They're going to have to cut, and that potentially undermines their inflation fight. And if economic growth is hotter than this, well, then that also undermines their inflation fight, and they're going to have to raise rates more. And they've already signaled that they want to pause. So it's this very narrow path, and this is basically exactly what they want to see. But the risks to growth are upside and downside risks are not good.
Yeah, absolutely. All right, so let's take a look at the recession update here.
And our recession probability ticking down slightly, basically all due to financial market, the short and medium term financial market type indicators. So if you look at the S&P 500, it's around 4,100. We're at the point now where on a year-over-year basis, stocks are probably, the S&P 500 is probably going to be up year-over-year for most of the time until August. Just because if you just look at the S&P 500 price chart, you see how it works out. So things like the VIX are probably going to be down on a year-over-year basis. High yield bond spreads are going to be roughly the same on a year-over-year basis. So as long as the S&P sort of stays stable, then some of these market indicators will look less bad just due to decay. But if we have it's very sensitive. So if there's a further downturn in equities from here, high yield bond spreads widen out, the VIX picks up, and then if the labor market softens at all, then the recession probability would pick back up quite significantly.
Mm-hmm. Okay, we're going to move on to talking about earnings. We get a lot of headlines on earnings about beating estimates, but when you look under the surface, estimates have come down quite a bit. So take us through the graphs we've structured here and explain what's actually happening under the headlines.
Mm-hmm. And this first chart will sort of play into how the financial media is covering this, which is, companies are generally beating estimates. So about 78% of the companies that have reported, and over 90% of companies have reported their Q1 earnings now. So it's pretty much done. But almost 80% have beaten earnings estimates. And we haven't been able to say that for quite a while. Really, this is the first time that companies have beat estimates, a higher percentage of them beating than sort of what happens on average, which on average about 76% of companies beat estimates. So it shows you how good analysts are, right? But this is the first time we've been able to say that really since Q3 2021. So that's been good. But beating these estimates, what does that mean in terms of actual earnings? And where are the beats coming from? For example, infotech as a sector is responsible for a good chunk of these positive surprises. And what actually happened? Well, coming into the quarter, we were expecting infotech as a sector to be down 15% year over year in earnings, and now they're only down 11. Great, and then consumer discretionary, but more specifically Amazon. Amazon beat estimates. They're responsible for almost all of the beat within the consumer discretionary sector because they're such a huge part of the sector. But they issued some downbeat guidance, especially on AWS, and their stock actually was not rewarded because they beat estimates. So it's definitely not as strong as a picture as is being painted.
So just elaborate a little bit more on sort of the idea of the downtrend and expectations and what's being rewarded and what's being punished.
Yeah. What you're seeing this quarter is companies that have come out and beat, the stock prices are really not getting rewarded. So this is the average price change 2 days before through 2 days after earnings releases. And companies that beat on average this quarter see their stock go up 30 basis points, when on average, over the last 5 years, you get rewarded about 1%. And then if you miss estimates, so a negative EPS surprise, you're getting punished almost twice as much as average. So, yeah, that's great. 78% of companies are beating, but the market really isn't rewarding them, because if you look at like Amazon, for example, they beat, but then out of the other side of their mouth, they talk about AWS is declining, so on and so forth. And so their stock is actually down. So the market is not getting too excited about these earnings beats. And that's consistent with the very narrow market leadership, right? If all these companies are beating and we were all getting excited about them beating, then you'd have more than 8 stocks representing the return of the S&P 500 year to date, right? So
yeah, absolutely. Let's turn to the next graph that looks at the potential for an earnings recession, which looks highly probable at this point.
Yeah, it's pretty much in the books. So, Q4 2022 was negative on a year-over-year basis. Q1 2023, if the quarter ended today, would be down 2.5% year-over-year. So in aggregate, heading into the quarter, analysts were expecting something like 6.7% year-over-year decline. But because of all those positive EPS surprises, we're only going to get a 2.5% decline. So that's 2 consecutive quarters, negative year-over-year earnings growth. That constitutes an earnings recession, technically speaking. And then the other thing we're seeing, if you look out to Q2 2023, those expectations have actually come down. So despite companies beating estimates in Q1, those beats are just being taken out of the estimates in Q2. So now we're expecting a 6.3% decline on a year-over-year basis. And then hopefully in Q3, we stabilize on a year-over-year, and then Q4 is where all the hope comes in. And the hope really comes from the fact that companies within the S&P 500 that have over 50% of their revenues from overseas, they're the ones primarily responsible for this negative earnings growth. And so you hope, as we get out to Q4, China is open, Europe has avoided recession, the UK has avoided recession, and the dollar isn't just on an absolute tear, being extremely strong. That's sort of normalized. And so the hope is those companies can make a bit of a comeback. But if there's any type of economic downturn later in the year, those estimates will not be realized.
And sort of what's baked into these estimates? I mean, how much of the debt ceiling is baked in here? How much of a rate cut is baked in here?
Yeah, I mean, virtually none of it. These are bottom up analyst estimates. So there's very limited macro overlay. You have a bunch of analysts focusing on individual companies, and talking about earnings and listening to what management is saying and so on and so forth. So they're generally rosy, and they generally miss large macro turning points, which is what we've designed our framework to not miss.
Right. Yep, that's great. Thanks for pointing that out. And then let's flip to the last graph, because Tina is being hunted, and
that's right.
Now we have an alternative.
Yep. And this is putting the earnings situation in sort of through our perspective, which is that's great, companies are beating estimates. But if you look at the forward earnings yield, so you look at 12 months out, what are S&P 500 earnings going to be? Turn that into a yield. It's 5.52%. Well, cash earns you 5% right now. So that gap, that 52 basis point gap, or the equity risk premium, how much extra compensation do you get to own a basket of stocks versus just keeping your money in cash? Well, that equity risk premium is the smallest since before the tech bubble burst. So this is not in equilibrium. Cash looks very cheap relative to stocks. Stocks look very expensive relative to cash. This has to normalize. And there are 3 ways it can basically normalize. One is cash goes down. The yield on cash goes down to 0. We don't think that's in the cards given inflation. I mean, the Fed controls that. So I would throw that out the window.
The Fed would have to cut rates.
Exactly. Fed would have to cut rates.
Aggressively, yes.
Yeah. So say no to that. Then equity earnings, S&P 500 earnings have to go up a lot. So you get more earnings for every dollar of stocks you own. Well, that's clearly not in the estimates. I mean, over the next 4 quarters, we're expecting like 1% earnings growth. So unless something crazy happens, that's not it. And the last thing that'll bring this into equilibrium is stocks just get cheaper. They get way cheaper. That seems like the path of least resistance here. As stocks get cheaper, equity risk premium goes up, just like happened during the tech bubble burst, just like happened during 2008, just like happened during COVID. So that's another reason why, not getting overly excited about 80% of companies beating estimates.
Yeah. Well, we'll wrap it up there for the week. If you have any questions, feel free to reach out to us or anyone in the private wealth team. And we'll be back next week with further updates. And thanks for joining.